Welcome to Pro News Flash. Let's dive into the latest developments. Moody's U.S. credit rating downgrade spooked Bitcoin, but not for long. According to HSBC, the quick trade truce between Washington and Beijing changed the rules of the game. It has permanently raised global risk appetite, allowing digital assets to flourish. Could the loss of the state's latest top rating stop the BTC-USD bulls? As it turns out, no. Bitcoin is being driven upwards by a crowd of retail investors. They are also driving the U.S. stock market. Small players don't care that the U.S. economy is slowing down, and the Fed is not going to cut rates. Traders are buying the S&P 500 and digital assets simply because they are rising. At the same time, Morgan Stanley's recommendation to buy the dips in stock indices is adding fuel to the fire of the rally in stocks and BTC. Traders are not particularly concerned about the fact that as Bitcoin grows, the number of fraudulent transactions increases. For example, criminals fraudulently gained access to Coinbase's customer base and demanded a ransom of $20 million for silence. Binance and Kraken also fell victim to the attack, but managed to protect themselves. In February, Bybit was hacked and $1.5 billion worth of cryptocurrency was stolen, the largest token theft in history. Meanwhile, Donald Trump continues to popularize digital assets by announcing a dinner party for holders of the Trump coin. Its value skyrocketed in the first few days of circulation, but has since drastically fallen. White House representatives do not see any conflict of interest in the fact that the U.S. president makes money in the industry that he himself promotes. Further dynamics of BTC-USD will depend on changes in global risk appetite. As the downgrade of the U.S. credit rating showed, fans of risky assets in general and Bitcoin in particular are hard to scare. There are more chances to restore the uptrend in case the resistance at 107,000 is broken. Stay tuned to Pro News Flash for more updates on the crypto market. Don't forget to like, share, and subscribe.